Welcome back to the Deep Dive. This is where we grab a bunch of sources on a topic, dig in deep, and we'll pull out the stuff you really need to know. Think of it as your shortcut to getting up to speed, maybe with a few surprises along the way. Today, we're looking at something that sounds simple enough, bonds. But, as you'll see, there's actually some pretty clever strategy involved, both for the companies issuing them and for you as an investor. It's more than just a basic loan.
That's exactly right. Bonds often get tagged as the safe or maybe even the boring bit of your portfolio, but honestly, they're absolutely essential. Often misunderstood, but essential, especially if you're a bit more conservative with your investments. Sure, they're generally lower risk, lower return than stocks, that's true, but really getting what they mean for companies and for you, that's key to feeling confident about finance.
Okay, so let's get right to it. The big question for today. Why do companies actually issue bonds in the first place? And maybe more importantly for our listeners, what does their reason mean for you when you're thinking about investing? We're really going to unpack the why behind bonds today. So basics first, let's just level set quickly. A bond, fundamentally, it's a loan, right? An investor, that's you, lends money to a company for a set time. In return, the company pays you interest, usually regularly, and then gives your original money, the principal, back when the bond matures. Seems straightforward.
It does seem straightforward on the surface, but like you said, the why is where it gets interesting. Why choose bonds over, say, just getting a loan from a bank or issuing more stock? Companies need cash, sure, but they want it on the best terms possible, and bonds offer some unique advantages there.
Okay, yeah, let's dig into that. Why bonds instead of a bank loan? I mean, wouldn't a bank loan just be simpler? Quicker? Maybe. What am I missing?
That's a really good question, and it's something companies think about a lot. There are two main reasons bonds often win out over bank loans. First off, interest rates. Often, companies can borrow huge sums of money from lots of bond investors at a lower rate than a bank would offer. Think about it, saving even a fraction of a percent on millions or billions in loans. They go straight to the bottom line. It's pure profit enhancement. So even really successful companies with plenty of cash might issue bonds. It's just cheaper money. And the second reason, maybe even bigger, freedom. Bank loans often come with strings attached, what they call covenants, things like, nope, no more debt until you pay us back, or you can't buy that other company. These rules can seriously limit a company's flexibility.
Okay, so the bank can kind of dictate strategy.
Exactly. Bonds typically have far fewer restrictions. So the company gets the cash without having the bank looking over its shoulder, telling it what it can and can't do strategically. That operational freedom is huge.
That really shifts the perspective. I wasn't thinking about those restrictions. So for a company that wants to grow fast or pivot quickly, being free from those bank rules is a massive competitive advantage, isn't it? It's not just about the interest rate.
Absolutely. Agility is key in today's market.
Okay, so bonds beat banks on rates and freedom. Got it. But what about stocks? Companies raise money all the time by issuing new shares. How do bonds compare to that route?
Right, another common way to get capital. Issuing stock or equity. The money raised doesn't have to be paid back like a loan, which sounds good, but, and this is a big but for existing owners, when a company issues new stock, it's basically selling off little pieces of ownership.
So it dilutes the ownership.
Precisely. If you owned 1% before, now you own less than 1% because there are more shares out there. Existing shareholders usually don't like that. Plus, it affects key numbers investors watch, like earnings per share or EPS. Well, if the company makes the same amount of profit next year, but now that profit has to be divided among more shares, your earnings per share goes down. And the market generally sees a falling EPS as a negative sign. It can hurt the stock price. Bonds avoid all that, you get the money, but ownership isn't diluted and EPS isn't directly impacted in the same way.
Okay, so it's like getting the capital injection without messing with the ownership structure or those key investor metrics. That makes bonds a pretty powerful tool for management then. Keep shareholders happy, keep control.
It really is. And the bond market itself is incredibly efficient and flexible for companies. Record keeping is simpler because for a given bond issue, everyone usually gets the same rate, same maturity date. But the real beauty is the variety. Companies can basically design bonds to meet their exact needs.
Variety. Okay, so it's not just one size fits all. What kind of variations are we talking about?
Oh, loads. The main things that determine the interest rate are the company's financial health, its credit quality, and the loan's length, the duration. Better finances, shorter loan, usually means lower interest rates for the company. And duration can be anything, really. Short term, maybe a year or two. Long term, 30 years isn't uncommon. There are even super rare things called perpetual bonds that technically pay interest forever.
Forever. Wow. Okay, what else?
Well, you got bonds backed by specific assets, collateralized debt obligations, CDOs. Think car loans or mortgages bundled up as security. If the company defaults, investors can claim those assets. Gives investors a bit more comfort.
Right, you have a claim on something tangible.
Exactly. Then there's the opposite. Unsecured debt, like credit card debt. Nothing specific backing it up. These are riskier for investors, so naturally they pay higher interest rates. And then things get really interesting with stuff like convertible bonds.
Convertible, what do they convert into?
Stock. They start as normal bonds, paying interest. But the investor gets the option later on to swap the bond for a set number of the company's shares. So you get the safety of the bond payments, but also the potential upside if the company's stock takes off.
Ooh, that sounds appealing for the investor. What's in it for the company?
Well, if the stock does well and investors convert, the company essentially turns debt into equity on its books without having to repay the principal, cleans up the balance sheet, and one more key type, callable bonds.
Callable, meaning the company can call them back.
Exactly. The company has the right to pay off the bond before its official maturity date.
Okay, as an investor, I'm thinking I want my interest payments for the full term. Why would a company want to cut that short?
Strategic advantage again. Think about interest rates. Let's say a company issued bonds years ago paying 7% interest, but now market rates have fallen to, say, 4%. If they issued callable bonds, they can say, okay, we're calling those expensive 7% bonds back. They pay you back your principal, maybe a small premium.
And then they issue new bonds at the lower 4% rate.
You got it. It's just like refinancing your mortgage when rates drop. Saves the company a ton on interest costs over the remaining years.
Okay, brilliant for the company's finance department. But for the investor holding that bond, what does it mean for you?
Yeah, that's the catch for the investor. Callable bonds are definitely more complex. If you're relying on that steady income stream, it might not be ideal. Because the company is most likely to call the bond precisely when interest rates have fallen. That's when your bond would otherwise be worth more on the market because it's paying an above market rate. But instead of benefiting from that, you just get your principal back, plus maybe a small bonus, and now you have to reinvest your money in a world of lower interest rates.
So the company's gain is potentially the investor's loss of opportunity. Good to know.
It's a trade-off you need to be aware of.
We've focused heavily on corporate bonds. What about government bonds, like U.S. Treasuries? Are they playing the same game?
Similar instruments, but different purpose. Corporate bonds fund business stuff, expansion, R&D, payroll. Government bonds fund public spending roads, schools, government operations. The big difference for investors is usually risk. Governments, especially stable ones, are generally seen as less likely to go bust than corporations.
So government bonds are safer, typically.
Generally, yes. And because they're seen as safer, they usually offer lower returns than corporate bonds. Corporate bonds have to offer a bit more interest to compensate investors for taking on that slightly higher company-specific risk.
Okay, so comparing risk levels. Corporate bonds generally riskier than government bonds, but are they safer than stocks overall?
Yeah, generally speaking, corporate bonds are considered safer than stocks. With a bond, you usually have that fixed interest payment and the return of principal date. It's predictable income, stocks. Huge potential upside, yes, but also the risk of big losses. The value can swing wildly. There's no guarantee of return. So a 4% bond return is steady. You miss the stock that jumps 20%, but you also miss the one that drops 20%. It really depends on your comfort level with risk.
Right. Your personal risk tolerance is key, always. And the big question people always ask about investments. Any tax breaks with corporate bonds, are they tax-free?
Nope. Wishful thinking. Corporate bonds are generally not tax-free. You'll likely owe taxes on the interest income you receive. And if you sell the bond for more than you paid before it matures, that capital gain is usually taxable too.
Okay, good to clarify. So wrapping this up, what's the big picture for you, the listener? We've seen companies use bonds very strategically, gives them amazing flexibility, tailoring maturities, deciding on collateral, adding features like convertibility or call options. It's a sophisticated toolkit.
Definitely. And for you as an investor, that means a huge range of choices out there. You can potentially find bonds that really fit your specific needs, your income goals, your risk appetite. But that variety means you absolutely have to do your homework or have someone knowledgeable do it for you. You need to understand what you're buying. Who are you lending to? How much will you earn? When do you get your money back? What are the specific risks?
Right. And let's quickly recap those risks. Interest rates going up could hurt your bond's value if you sell early. Call risk your bond getting paid back early, especially with callable bonds, usually when rates are low. And of course, the company itself could face financial trouble, even bankruptcy. You could lose some, or potentially all, of your investment in that worst-case scenario.
It's true. And look, if digging into individual bonds feels like too much, there are other options. Things like bond funds or aggregate bond ETFs. Professionals manage a pool of bonds for you. You get diversification, but of course, you pay management fees for that service.
So maybe a final thought to leave everyone with. Bonds might seem like the quiet, steady part of investing. But underneath, it's this really dynamic world where company strategy and your investment opportunities are constantly interacting. The choices a company makes about issuing bonds, why they do it, how they structure it, tells you a lot about their plans and health. And that directly shapes the kinds of risks and rewards available to you. Understanding that connection adds a whole new layer to these seemingly simple bits of paper. Next time you hear about bonds, you'll know there's quite a story behind them.